Good afternoon, and in this report, I'm going to show you the analysis of financial statement of company KONE. My name is Anishin Katenian, and we shall start. In this report, I decided to analyze financial statement of company KONE. The reasons for choosing this company are quite obvious. First of all, KONE is one of the largest manufacturers of elevators and escalators worldwide. It is a fast-growing company which has generated over 6.9 billion of revenue. Secondly, it is a Finnish company with headquarters situated in Espoo, Helsinki. And finally, the company has a clear financial statement which I will analyze. Okay, I would like to say a couple of words as introduction about the company first. KONE was founded in Helsinki 27th October 1910. At first it was named Osakeyhtiö KONE Aktiebolag, the subsidiary of Gottfried Stromberg Oy. In 1918, KONE started producing and setting up own elevators, even though they had only 50 people employed. After 6 years, the company has been purchased by the entrepreneur Harold Herlin. He became new chairman of the board of directors, and since that year until nowadays, the company is being controlled by one of the wealthiest families in Finland, Harold. Over the years, KONE has proven its ability to adapt to a changing world as well as to create new opportunities for the company to grow. Stable ownership by 4 generations of the same family has created a strong and supportive environment for continuous development. Company is keeping the expansion to new markets. In 2009, KONE acquires Fairway Elevator Company in Philadelphia to enter the modernization market in that area. It also builds new headquarters in the United States in 2011, acquires Long Elevator Company, headquarters in Springfield, acquired its Israeli distributor Israel Lift until the end of the year 2013, and by the end of the 2014 it has entered the African market by acquiring the elevator and escalator business of Marriott and Scott, situated in Kenya, and Marriott East Africa Limited, its authorized distributors in East and Central Africa. In 2014, KONE was ranked 42nd out of the top 100 most innovative companies in the world by the well-known business magazine Forbes. This was the 4th consecutive year KONE was recognized in this ranking. Out of all European companies listed in 2014, KONE was ranked an impressive 6th, and KONE was the only elevator and escalator company featured on Forbes' list. Now we are going to look at preliminary research. As we can see from the financial statement of KONE made in 2013, company has made some major investments in 21st century. The headquarters of the corporation has acquired new businesses in new emerging markets, for example Africa, Asia, Israel. Overall, successful growth could be seen on the graphs of orders received, sales, EBIT, cash flow, and working capital. Since 2011 till 2013, orders has increased from 4,465 million euros to 6,151,000, which is quite significant growth for such a short period of time. Sales has increased from 5,225,000 to 1,933,000. Cash flow became 1,213,000 from 820,000. And EBIT shows us 15% growth, being 953 million on 2013. The tendency of growth in sales shows us that the company is becoming wealthier with good opportunities for expansion on the market. The most profitable area of sales is EMEA, which stands for Europe, the Middle East and Africa, being 46% of the market. That is quite obvious as the company headquarters are situated in Europe. Coming back to the graph of the sales by area, Asia Pacific comes on the second place, making 38% of the total shares of sales. And Americas, being the third largest, is 16% of the market. The consolidated statement of equity shows us detailed information on the changes in such things as share capital, share premium, account paid up, unrestricted equity reserve, fair value and other reserves, translation differences, remeasurements of employee benefits, own shares, retained earnings, net income for the period, not controlling interests, and total equity. And though with these graphs we can see a slight decrease in all of these terms from 2012 to 2013. This was exactly which I was talking about these percentages right here. Now we are going to SWOT analysis. Strength of the company. It is well known around the world. It has also a reputation of a reliable company. High quality of products is also its major strength. It has vast resources, strong market. It is a strong market leader. Also, KONE has alliance with companies in the Asian market, for example Toshiba, which makes its influence worldwide quite strong, not only in Europe but in Asia as well. It has strong acquisition strategy, as we already talked before. It has acquired numerous of companies in different emerging markets. Also, it shows high growth rate and high profitability and revenue. Looking at its weaknesses, we can see that strength overwhelm its weaknesses, but of course there are some potential weaknesses even in such big company. Some of them might be competitive market, costs, future debt and loans, reliance on Europe, and future competition, because it is always growing. So let's move on to opportunities. Strong growth in Asia, as I already told, new acquisitions, new products and services, development of technologies would be also an opportunity, expansion of the market and cooperation with other companies will build up a stronger and much more stronger brand. Actually, it is quite strong already. So let's look at the threats, potential threats. Strong competition on the market, price changes, increasing costs of materials and different other costs as well. External business risks. Also, one of the potential threats could be increase in labor costs and increase in costs of raw materials. Actually, I can say that strength of the company overwhelm the potential threats. Weaknesses are compensated by the fact that the company's brand is well known around the world. and the revenues of the company. High prices of the company are reliant and could be explained by the presence of specific expensive materials. These components and materials indicate high quality of the products. Due to the fact that the company produces high quality products, it will have high competition presence on the market. To sum everything up, in my opinion, it can be concluded that the company is a strong brand and has huge opportunities for future development and growth. Here we can see the vertical analysis of the company. I was comparing 2 years, 2012 and 2013. Everything here in this table is shown in millions of euros. So in the first part we can see in the first table there is difference in euros, and the second difference in percentage. So as you can see from this graph, sales has increased by 655 million euros, which makes 10.4 percentages. This is quite good growth for such company in my opinion. So let's look at some other graphs. Operating income has increased by 20.4%. Income before taxes also increased by 19.4%, although the taxes increased as well. But doesn't matter because our sales overwhelm these taxes. So net income is 102 million euros, which makes 16.7% growth. Also, operating income, wages and salaries, direct materials and supplies have increased by the numbers shown in the table, as you can see. Of course, due to the fact that the costs go up as well, they increased by 514 million euros, which makes it 8.5% increase comparing to the 2013. Horizontal analysis compares account balances and ratios over different time and period. In this case, we can see how profitable the company is in its progress over the years. And in my opinion, I should say that we can see potential growth and growth in sales and revenues, which is definitely a positive thing. Let's move on to vertical analysis. Here we can see, excuse me, but it should be written on the top vertical analysis, but the table is correct. Here we can see vertical analysis, which shows us the vertical analysis is method of financial statement analysis in which main entries in balance sheet are represented as a proportion of the total account. The most important advantage is that it makes it easy to see relative annual changes within the business. So here we can see the differences between 2 years as well, but in percentage, as I already told. Operating income was 12.6% in 2012, and it became 13.7% in the 2013, which shows us growth. Income before taxes also have grown on 1% comparing these 2 years, and net income and taxes has grown as well, but the costs, they decreased. comparing to the total sales, which is definitely a good thing. Vertical analysis shows that the whole process is showing positive progress, as the total cost and expenses have declined while operating income and net income show a steady growth. Now we move on to our third stage, ratio analysis. And the first table which will be present here, it shows us profitability. In this table, the author has calculated and analyzed different points of the company. For example, some of them are gross margin percentage, operating margin, which is EBITDA, operating profit, which could be called EBIT, net profit margin percentage, return on investments, return on capital employed percentage, return on owner's equity percentage. Net profit margin shows percentage of sales is made up of net income. This ratio is low. The company should try achieving higher ratios. They can do this by either generating more revenues while keeping expenses constant, or keep revenues constant and lower expenses. Let's move on to the next slide. On this slide we can see a table of efficiency, which is also one of the ratio analysis parts. Here we can see 2 points: debtors days and creditors days. In 2012, debtors days were 76, while in 2013 they're 72, which we can see that there is a small decrease in them. Also in 2012, creditors days were 30, while in 2013 31.19. The figures of debtors days are beyond typical target of 40 to 50 days. An increasing number of debtor days might suggest overly generous credit terms or problems with product quality. The company takes around 30 days to pay its bills. This figure is normal, which means the management is successfully maintaining the company's credit agreement. We're going to move on to the next slide, which shows us the liquidity. In this slide, some of the ratios that are present are current ratio, quick ratio, working capital, and the current ratios in 2012 and 2013 are between 1.2 and 2.0, which is quite sufficient. It means that the company is running efficiently and is able to meet short-term obligations with short-term assets in the near future. But the ratio is declining with its debt increasing, which is a negative tendency for the company. Quick ratios figures in 2012 and 13 are less than 1. This means that the company won't be able to pay off all of the current liabilities with quick assets. There might be a risk of losing solvency. Working capital figure is positive, but not high. It shows the amount of capital invested in resources that are subject to quick turnover. Here, in one of the last slides, we can see the final figure, which is capital structure. Here I was analyzing the debt, equity ratio and equity ratio. Concerning the size of the capital structure of the company, debt equity ratio is at sufficient rate. Nevertheless, the higher it gets, the more financially dependent the firm gets. Analysis of the equity ratio has shown that the company relies both on the equity and loans equally. It also shows that potential creditors that the company is more sustainable and less risky to lend future loans. And for the conclusion, I would like to say that the future of KONE Corporation is looking very bright to me. There is already starting from 1910 up to this day it has built a solid base for future development, stable growth and worldwide expansion. KONE has been controlled by Herald family for a quite long period of time. Now, in my opinion, that was one of the key factors of the success of our organization due to the fact that clear idea has been followed through the development which led to the situation at the current day. We can see also growth in new emerging markets and increase in sales and brand awareness and company keeps buying properties and making crucial strategic investments. This will definitely lead to future growth of sales and overall increase of the brand itself. And on these words, I would like to conclude my presentation and financial analysis of the company KONE. Thank you for your attention, and this was Anishenko Daniel. Goodbye.